Hi everyone and welcome to Investing by the Books, a podcast by Redeye. I'm your host Eddie Palmgren and not next to me this time, but on Zencaster is my friend and colleague Niklas Sävås. How are you?
I'm quite fine. I got some food poisoning yesterday, so that's why I'm not in the office, unfortunately. Would be the last day before vacation, so would have been nice to meet you and have a glass of wine or so on. So I'm a bit sad about that.
Yeah, me too. Who is our guest today then?
We don't have any guests today, so this would be interesting.
Yeah, today is a special episode as we have gotten some questions on what our takeaways are and how these can be applied practically. So it's been 25 episodes and we thought it would be a good moment to discuss these lessons. What do you think of the journey so far?
I think it's been so interesting to kick this off and really to have a new guest every 2 weeks or so on, and I think it's been amazing to speak with all these thought leaders and to hear their perspectives. I mean, these are people that you have read about before, you have listened to them, and now you have the chance to speak to them. And when you read a book, often I have a lot of questions, and to get them answered by the people directly is so good. How about you?
Yeah, in some ways it's really been unreal to have these guests on the podcast. And some topics have been quite new for me, actually. For example, shareholder activism that we talked with Jeff Gramm and his book, Dear Chairman, about in episode 6. That is not something that I knew that much about. And now we heard and read the whole story about how shareholder activism has evolved over the last century. And that was really interesting, I think. And that's something we have been coming back to in other episodes. For example, we talked about that with Patrick Wallén in episode 14 and the book Business Adventures and Buffett's salad oil scandal when he bought American Express and so on. And also in the recent episode with Richard Lawrence, who has been an activist himself, but in a different way. He's more of a fund manager approaching the companies in a more friendly way. Some of those activists have been quite hostile. And another highlight, of course, for me is really to get in touch with some of you listeners. It's been really nice to both get interaction on Twitter and also meet some of you in Stockholm and in Omaha and so on. And that has given me a lot of inspiration and encouragement to keep going. So thank you all for the support. And if we go into the lessons, what have you learned from the first 25 episodes?
There are a few general takeaways. One takeaway I have is how many connections we're able to do between the episodes. So even though we speak to a person who have written something in one subject, we make connections with totally different books, which is really nice. I think one of maybe the most interesting takeaway for me has been, to really speak with some of these superstars that we have interviewed, and they are so down to earth. I mean, I'm not surprised because, having talked to a lot of people in the investing community, I think many people are like that. But it's just so nice when you really get it confirmed when you speak to some of these people that are maybe a level above what you'd normally speak to in terms of knowledge and experience.
Yeah, and it's very generous of them to share all their insights and also to take the time to come on the podcast. So I definitely agree. And the finance industry is not known or famous for having a great reputation. And there are, of course, many cases of greed that proves that point. And we have talked about that in some episodes, like number 12 with Bethany McLean, for example, who has written the great book on the Enron scandal. And but yeah, on the other hand, there are so many examples of people who have high integrity and are very generous and kind. So they just had this like genuine passion for investing in business, and that really shines through. And to solve this intellectual challenge, like in the most competitive field, as Richard Lawrence mentioned in episode 25.
Yeah, it could be that we get a bit of a bias from our filtering process has been really good, I think. So, before we invite anyone to our podcast, we know a bit about them. We know that they're not like the bad examples of finance. So it's similar to how you do when you research businesses, I think, because you do some initial digging and throw the idea away if you see some some marks that you don't like. So I think that's similar. And we've had guests ranging from business manager, investigative journalists, money managers, and private investors. And I really think what we would like to show is that there is so much to learn from different type of people in this business. When you're an investor, I think many investors maybe listen too much to other investors. And not and too little to these like investigative journalists and business managers and also others like psychologists and so on. And that's what we really want to show. I think it's some great investors talks about the benefits of cloning, and I think that concept has been a bit overused sometimes because I don't like the idea when you clone a specific stock ID from someone. You can do that, but then you need to do your own work and get your own conviction. So you can get an ID from someone, but not the conviction. And I think that's powerful. And I think also it helps to not only read pure investment books. And I think probably we will expand even further to talk about more diverse subjects in the future. And while it's clear for our fans that maybe our fans was a bit too strong a word. I don't know how many strong fans we have, but we have some, and I'm really appreciative of that. And ourselves, we are huge Charlie Munger fans, and we love his concept of having a multidisciplinary thinking and not only have a few tools in the toolbox, but many. And that was something we discussed early in the podcast with Jake Taylor in episode 2, and also with Robert Hagstrom in episode 16, and also for example Daniel Chang, which we have quite an interesting story about what happened with Daniel Chang after interviewing him. So maybe you can take that, Eddie.
Yeah, we noticed on Twitter that Charlie Munger was speaking at a conference, and it was on a link. So he was in his own home office, and then you could see on his table next to him there were a couple of books, and everyone on Twitter were trying to figure out which books those were. And we noticed that one of them was Daniel Chang's book, An Investment Thinking Toolbox. And we just sent an email to him and the picture, of course, and he woke up and said, "Now I can die happy." So he was really excited about that.
Yeah, it was a fun story, and I think you're a bit humble there because you actually influenced Daniel to actually send the book to both Warren and Charlie.
Yeah, that's true. And we also spoke about Poor Charlie's Almanac in a recent episode in number 23 here with Rajiv Agrawal. So it was nice that we have that book covered and included in the episode list. It's such a broad book. There are so many topics in there. But also from other books, it's enough that you only find like one or two sentences, and that can really change your behavior or your life. So that's been one general takeaway from me from the conversations and from reading the books.
And I don't think we're done with Poor Charlie's Almanac. We didn't discuss the whole book. We discussed parts of it, maybe some of the most interesting ones, but I think you could do one episode per chapter, more or less. There's so much knowledge about that. And I use it as like a bed table book that I can just, I don't have anything to read right now. So I pick up that book and read a chapter or read some pages, and that just tilts me in the right direction. So I found that as an investor, it's hard. It's easy that you get dragged into these, what's happening now in the market and so on. And then you go down to your library and really pick up some of these great books, and you get tilted in the right direction, and you start to think more long term and so on. Because a lot of the financial media thoughts like what's going to happen in 3 to 6 months or maybe a year, and that's noise. So I think that's hugely beneficial, and Poor Charlie's Almanac is one of my favorite in that aspect, but there are many similar ones I think that you can use for the same.
Yeah, and Rajiv said he also uses the book in that way. He reads one chapter or a few pages every other week. So that's definitely a good way to use it. But some other people that he knew, they read the whole book from cover to cover like once a year. So yeah, we can definitely come back to that book maybe once a year.
Yeah, what do you think about like rereading books?
Yeah, I mean, it's definitely something that is valuable. We have discussed that before, that if you read it once, you might be in a specific state when you read that. So you might ignore some information. I mean, I've been thinking about that recently, now that we're in a bear market, that everything that I read, when there is information about how to deal with a bear market, for example, that we spoke to with Richard Lawrence about, and others as well, and in other books. Now it's more, I think I am influenced by being in a bear market. I take it more seriously. I think more about it. If I would have read this like 2 years ago or something, I would be less impacted by it.
It's just I think that's so interesting. And even though we read all these books and we think about these concepts, I mean, you still get humbled by the market from time to time. And this has been one of those experiences in my view, that in like last year, most of the investors were too optimistic, and that includes me. And I thought about the opportunities more than the risks, and that's I think the important thing is that you realize that, and you try to learn from it, and then you try to get the perspective that you need for the current circumstances. So don't think about what you have lost. Think about what opportunities are ahead, and always think like that. I mean, I think you need to think about if a mistake has been a mistake or not. I mean, you have this concept that Taleb talks about, alternative histories. And I mean, of course, the risk in the market was high last year, but also this is one scenario that could have happened, and now it happened. And now some of the people that said, yeah, this is going to happen, look like heroes and look like, those are the ones that people listen to now. But that's one scenario. It could have been another scenario, and then we would have spoken about completely different things now. So I think the important thing is having this like probability distribution in your mind, that, I mean, a lot of scenarios can happen, and you need to position yourself to come out okay in most of these scenarios.
And I know Sir John Templeton has said that the biggest mistake is to not invest at all. So speaking about mistakes, but how much are you rereading books?
I have a few books that I reread quite frequently. It's just the hard thing is that there is so much to read, and doing this podcast is about, I mean, if we took out the same book time and time again, then yeah, that wouldn't be so interesting maybe, because it's one thing that I think we'll come back to is that books are really subjective. So I think the important thing is that if you have changed, then you can have a huge benefit of reading a good book that you read before, because now you have a completely different way of looking at things. So that's the biggest thing that I often hear, like people said that book changed my trajectory in a huge way. And then another investor say, but no, I didn't get anything from that book. But it can be a great book, but it just didn't click for one person and really clicked for the other. And in a way, it's like if you're sick, some medicine works at one time and for you, but not for the other. So I think it's just so subjective, and I think that's one of the reasons why some of our guests have a problem actually recommending books. I think we talked with Jake Taylor about that he has a habit of not recommending books because it's so subjective.
I really have recency bias here, because we talk a lot about Richard Lawrence that we have in the latest episode, but he was talking about taking slivers of wisdom from different investors like John Neff and so on, and putting it all together to his model. Let's hear Richard Lawrence explain it himself.
You know, there's a great investor, John Neff. Well, John Neff told me about an equation and how he was looking at the construction of his portfolio. Boom. I don't know what he wrote about in his other 290 pages, but those 2 or 3 pages I really got.
And what Richard Lawrence was talking about is something that I connect with what Sean Iddings was telling us about in our very first episode, to find your own investment style. Let's go back and listen to that.
One thing that I think is important to talk about is style. And so when I say style, I think anybody who wants to get great results in whatever they do, they have their own style. And so when I say style, like Warren Buffett, like he's got his own style. He's a straight shooter, great communicator, simple. He has his own way of operating. And I think a lot of people want to imitate and copy that, which is good. And you get to learn a lot of important topics by doing that. But with any artist, they learn from the best, they imitate, and then they get to a point where they find themselves and they find that internal voice, and they meld all these different influences. And I think of it like a big pot of gumbo, where you throw in all these great influences as ingredients, and then you get to a point where you just start stirring it together, and then you take a scoop out of it, and you get a really unique version of all of those influences, which is yourself or your own style. And that really separates the greats from the non-greats.
This dish, a stew of gumbo, it was funny because we had to try that when we saw it on the menu in Omaha. What did you think about it?
I don't think it was the best gumbo. So I mean, it was the first one I tried, but it was a good restaurant. But I just think that, I don't know, the gumbo wasn't my favorite on the trip. But I think it depends on what you put in it. And I mean, it sounded like gumbo, you can put more or less anything in it.
So using the metaphor of gumbo, how would you describe your investment style?
I think I've evolved over time. I started like a Benjamin Graham type of investor, purely quantitative. I got influenced because that was more or less the first thing I read on investing. I read some Swedish books on investing before, but then when I read Benjamin Graham, it just made a lot of sense. But after a while, I realized that I couldn't find so many stocks with those characteristics, those low valuations that Benjamin Graham talked about. I mean, when he wrote that book, it was around the time with the Great Depression, and there was a lot of opportunities that were cheap. And even though, I mean, some investors currently use this net approach that you try to buy businesses more or less with that the market value is the same as the cash position in the business or more. And it's still possible, I think. I mean, if you have a low capital base and so on, you can find opportunities like that, especially in bear markets, which we have now. I just feel like, for me, it's more interesting to read about businesses itself, to speak with managers, to learn about what role business have in society as a whole, and also to apply all these tools that we talk about. Like, okay, what can you learn from different subjects and use in order to process information better and choose which sources to read. And I find that, investing in quality companies fits that quite well, because these quality companies with strong barriers to entries, they have a longer durability often. And I mean, if you look at, for example, we talked with Heather Brilliant on the book Why Most Matter, and they have this the Morningstar index of quality companies, and you can see how they have outperformed over time. So it fits with Charlie Munger's phrase, sit on your ass investing. If you find great companies, you can sit on your ass and you don't need to do so much. The difficult thing is that sometimes you may overpay for those businesses. And that was a problem last year, I think, for many investors, that, this phrase came up on Twitter, never sell, that you just buy businesses and hold them for the long term. And I would like to do a survey on those investors who said that, who have actually hold on to their positions. And if they hold on to their positions, I think many of them think it was a mistake, because even though these businesses are not maybe failures in the long term, if you're down like 80 to 90%, that's tough. So I think valuation matters a lot, and so I would think I like this. I mean, quality at a reasonable price. I think that's something I really like. But sometimes I also go in and do this kind of deep value stuff situations. If I find something that's clearly mispriced, I do that. But it's a smaller and smaller part of my portfolio.
Yeah, I guess it's not really worth the time to do those small.
Exactly. It depends on the capital base and so on.
Yeah, the hard part is to figure out, well, quality is also hard to define, but definitely what is a reasonable valuation? That's something you can talk about for hours.
It's the art part.
Yeah, exactly. And the art part and the art of selling was something we covered a little bit with Richard Lawrence. And this quote of you getting tomorrow's price today that he was talking about was something that you liked as well.
Yeah, it really resonated. And I mean, it's, I think a lot of investors would have benefited from reading that last year. But probably most of them wouldn't really do the connection and actually sell because of that. So it's, yeah. How about you?
Yeah, my investment style has also evolved a lot over the years, starting with trying to find these the dividend payers, the stable companies, and then moving over to more and more high-risk companies, I would say, smaller ones, where you're more looking for a catalyst and more special situation, and then tilting towards quality and compounders over the last years. So, but you've been honing and refining your investment style for the last 15 years almost, and I'm on a similar trajectory. But is there something over the last year during the podcast and everything that we have talked about that has changed your style in some way?
I mean, in some way, I've got influenced by the concept we spoke about right now about getting tomorrow's price today. I think when I've been I started out as quite a boring investor. I try to, only invest in the ideas that really, really made sense. And we had like a strong dividend and low PE and so on. And I think when I moved to Redeye, we focus on smaller tech and life science companies. And if you find good companies that are small, growing a lot, they can be huge winners. And I think I got influenced by that in the recent year. And I maybe a bit too much at the wrong time. So I think I tilted a bit too far in one direction, and I'm tilting back a bit now. So I think that's not a huge change in the philosophy. It's more about my process and so on. But I think that's been quite interesting, and also it's about this. Even though I've been investing for 15 years, I started after the financial crisis. I haven't really been in a huge bear market before, and we will see what happens now. But I think you have so much to learn from being in bear markets to see how you react. Try to think clearly when everything, like when you see everything just your portfolio is getting crushed. And I think you just need to stop in that time and just think about what has happened, what's the current environment like, what's the best decisions I can do now, and also, of course, take the lessons from this. That last year it felt like everybody has had this huge time horizon in their investments. And to just notice that you can go from it felt like you had like a 10, 20, 30 year time horizon to now it seems like everybody thinks about the next quarter. It's like they're connected to the financial media. Everybody think okay, how much cash do these businesses have on the balance sheet? How much free cash flow do they generate? And those are concepts that you should think about always. I think they get maybe overemphasized currently. that now it seems like everybody thinks that that's the case, and probably a lot of that is priced in. So you can get a lot of opportunities in the, so to speak, businesses that maybe have some problems ahead, but where you feel confident in the management and that the business can start to generate healthy cash flows in the future. I've been thinking a lot about this concept about maintenance capex and growth capex. So if a company invests a lot in growth activities, it causes, of course, the earnings to go down because it's not it's just part of the expense line. It's not balanced on the balance sheet. So I think that's a concept that I have with me from before, and I think that's more or less. It seems a bit forgotten at this time that some businesses, it's not many businesses, but some businesses have higher earnings potential and quite in the near to midterm than what you see. So I think you just need to keep do the work, keep thinking about what's like the steady state earnings for a business, what's the peak margins like, and try to check as many companies as you can, because now is our opportunity.
Yeah, it's fascinating how fast it can go. And for our listeners, this is in the middle of June that we are recording this, so the market might have changed when we release it.
Probably.
In one way or another. But it's funny because we've been talking about bear markets, we've been reading about it, but then it's always a little bit different when you actually are in it. And to me, I feel like many people we talk to, they think that, we're kind of gotten used to that bear markets are very short. It's tough for a short while and then it's back up again. And people are already thinking about the next bull market. But like when you read about the 1970s or so on, it can really go on for many years. And also when you read about other markets who has been in bear markets for decades, it's really something, okay, maybe it's not very probabilistic that will happen, but there is a chance that there will be an extended bear market and you really have to have the capacity to suffer through that.
Probably one reason is that a lot of investors are quite young. They haven't been part of this for decades. So, if you have 1 decade of experience, that's been the case. And you think that will always be the case. But that's why history is so important. And I think history is probably a subject that we will go into more and more. Another concept that we discussed that I felt was really interesting about actually doing the work and trying to get an edge as an investor is driven by what we spoke about with Avner Mandelman. So how has he influenced your thinking?
Well, I did know about him for the last 5 years or so when I was an equity analyst as well. We went through that book, The Sleuth Investor. So I know about the concepts, which is really doing the hard work, being a detective and getting out in the real world. But of course, reading the book now and talking to him re-emphasized that it's not the same thing sitting behind your desk and reading annual reports or talking to management even. You have to go out there and really gain an edge. And there is really an edge to gain from talking to competitors, suppliers, and other people in an industry or just on the street. So, well, I haven't been doing that much of the work. And he is very under-followed. He has like 200 followers on his YouTube channel. And his book has been out for 15 years, but not many people know about him. So it was really nice to have that conversation and actually highlight all his work. But also for myself, I haven't been doing so much of the work. It's really a full-time job to do that work. But you have been doing a little bit more of it, I think.
I've done some work. I would like to do more. But I think what you discussed there is so important that, some of the guests we have, they won't be, hugely renowned in the industry, and they won't have like thousands and thousands of followers on Twitter and so on. But what they have to say can still be hugely interesting. And it's just this concept about some things haven't really popped yet. They haven't got the interest that maybe they deserve sometimes. So sometimes it's of course well deserved, but sometimes you have so much to learn from people that are not in the limelight, so to speak.
So are there any other specific lessons that you have from the first 25 episodes?
I mean, there are tons. I think going back to, again, Avner Mandelmann and gaining physical evidence, I think that's been one of the... I mean, it's just... Sometimes you feel like you don't need to do all the work, but then you realize that you actually need to do something different from others. I mean, one way is actually to think different. We have this concept about how you gain an edge. You can have like an informational edge to have more information than others. And that's part of that you can get through the concept with Avner Mandelmann. You actually just know more about the business, what's happening, what's going on currently, and so on. The other is analytical edge, where you read the same information, but you just have a different angle on it. And for that, I think it can help a lot to have like this knowledge about history and psychology and so on that we speak about. And I also feel that the technical or structural edge is a bit underappreciated sometimes. It's just that you can actually gain like quite an easy edge by just understanding, for example, how index funds work. We have had a few of those in Sweden where a company is listed on the big list, so to speak, and you feel like, okay, now it's announced and everything, and you have an upcoming date coming in a few months, and then more or less, everything goes on as normal, nothing happens, and then when we approach like the last few days, you sometimes get a pop of like 10 to 15%, and then it goes down after that. And we have seen that pattern on, and I think that's just only one pattern, but there are so many of those patterns. And I think I would the person I would like to discuss this with maybe more than anyone is Jim Simmons. I read this or the biography of Renaissance, which was not I don't think Jim Simmons approved the book, so the author did it on his own. But I think that firm knows about all of these different, the structural edges. They probably have other edges, behavioral edges as well. But I just think that's underappreciated and something I would like to discuss with someone who really knows this.
Yeah, because they can see if there's a big transaction going on in the market, and then they can get ahead in the queue or something like that, right?
Yeah, and also, just understand these things with which listings that are upcoming and so on.
Yeah, we can see that in their performance.
Exactly.
So another piece of the puzzle is the people part, and that is something we have in our quality rating. Have you gained any insights on the people side?
I think that's one part of the philosophy that maybe has changed lately, and that's just how important the people are for the business. So I think Richard Lawrence said it best in episode 25.
I think the businessman made the business. Okay. So yes, we need the business, and then we need to reflect also that guy had a big part of it. Yeah, sure, he got lucky in some cases and whatnot, but usually you build a big business that's super profitable. You did some things really correctly. So I think they're a little bit joined at the hip. And when you look at our investment philosophy, superior businesses, that's the profitability of the business. That's the cash flow. Management with integrity and know-how to run a public company. That's the management. Disciplined valuation. That's the valuation you pay, because you can get the best management and the best company. You pay the wrong price, end of story. And then long duration, because the more long duration stocks you can get into, the easier your life is. That coming together is what the secret sauce is.
Without the founder, you don't have the business. And it's just that what comes first is the founder. And if you can realize if a founder is really a thought leader and with the right strategy and that will build the right culture, if you can do that early, then I think that's so important for a business. And I think also speaking with, for example, Rajiv Agrawal on investing in India, founder-led businesses is key, but not all founder-led businesses are good ones. Some are not there to serve the minority shareholders. But to get that right is really key. So Rajiv said that, if you can get the people behind the business right, then you have done a lot of work, and you get more often you get wrong on the people than the business. The hard part is, of course, the understanding. If a person is a visionary or a fraud, for example, a concept we discussed with Bethany McLean.
The most key character is Jeff Skilling, who was the chief operating officer of Enron, really its creator and its CEO for the last year of its existence. I still find him a fascinating character. I've talked sometimes about this fine line between a visionary and a fraud, where it often is just the outcome that determines how somebody is seen. And I think if Enron had been Tesla and had continued to be able to raise money from the market and hadn't had this crisis of confidence that suddenly stopped it from being able to get cash from investors, from the capital markets, I think Jeff Skilling could have gone down in history as a visionary. One of the businesses he had created was something called Enron Broadband, which essentially was Netflix ahead of its time. But his really, I've often thought we all have fatal flaws. I think his fatal flaw was that he needed success before it had actually come. And so he needed Enron to be a star for his own ego. And so he promised Wall Street a certain amount of earnings every quarter, and damn, Enron was going to deliver.
Again, the concept of alternative histories. I think that's just a hugely important concept that sometimes you can just, you would be seen as a fraud, but you have also been a visionary. And we just think binary. We think either fraud or visionary. It's not in the middle. And sometimes the truth is more in the middle. I don't want to back Skilling, because I think in the end the company failed, and I think management did things that they shouldn't have done. It's just that when a person is put in a corner and don't have any way to run, more or less, then we as humans do strange things. And I think that's something when you read psychology, that's just something that you realize that it's not, we are hugely influenced by that.
Yeah, and also I would have been swayed in that moment if I was like an analyst for Enron. I think it's easy to be, because he was working so hard and he seemed so passionate. But then you have to ask yourself, okay, what is his incentive? What is the motivation? What is really driving him? And I think that is very hard to determine, because you kind of have to know the person and understand what is his main incentive. But that is something we have tried to cover in the quality rating we have on the people section. So let's hear our CEO, Björn Fahlén, speak about the people aspect in Redeye's quality rating from episode 17.
To answer the key question, does the business have great people behind it? We answer questions in 7 subcategories: business passion, execution capability, capital allocation, investor communication, executive compensation, ownership strength, and board leadership. All these subcategories are assessed on 5 checks of quantitative and qualitative questions. And each check is allocated 1 point in the question. In the question, if the question can be answered with a yes, and the total number of these points makes up each subcategory score on a scale that ranges from 0 to 5, rounded up to the nearest whole number.
Another specific lesson concerns focus, and we had Pete Davis on the podcast quite early, speaking about being committed to things, to be dedicated to certain things that you want to support. And we also spoke with Gillian about different mentors. What's your take on those things that we spoke about with them? Have that influenced you in any way? That you have you started to appreciate having focus and passion on everything you do? Or how do you think about that?
The podcast is a good example of something that we are really passionate about, and we have to focus a lot to, when you read the book. And before, when I read a book, maybe I put more focus into it now, because now I know that I will ask questions and so on. So that's a positive effect of that. But I think in the commitment and dedication part that Pete Davis has written about, that has also influenced me on a personal level as well. I'm thinking, in many situations, I'm thinking, okay, but if I do this commitment, it will be for a long time, and there might be something at the end of that. I mean, I'm more long-term in that way. You see something you start doing now, but it also has to do with, like, we've been reading a lot about compounding and so on, and talking about that concept, and I think that fits very well into that commitment and dedication as well. If you are really going for something, you will do these small changes every day, and that will take you somewhere. And I think many people are very focused on what is happening here and now, and that is, of course, good, but they don't think about the consequences, and then also, of course, the consequences of consequences and so on. So those are some concepts that I have with me all the time. How do you feel about those?
No, I agree. I really agree. I don't have anything important to add. So to quote,
nothing to add.
Yeah, to quote Munger, I've got nothing to add. We've also, what's been good is that we have one good part about this podcast project as a whole is that we have become really good friends, and we discuss all these concepts like all the time, more or less. That how can we improve? What can we do better? Both about the podcast and also about other subjects. And of course, we have read a lot of books the last year, and I mean, I was a huge reader before, but as you say, I mean, now the problem I thought before the podcast was that I was going to be pushed into reading books that I didn't want to read, that I didn't like at the time. So I don't think that's been a problem. I think I've got a lot out of many books that we have read, or most all of them, I would say.
And you also work as an equity analyst, so you can have that real world example on the side.
Yeah, exactly. And I think that's really the concept I want to discuss a bit more, that you need some kind of healthy mix between reading books and also practice in the real world. So if you only read books, it's hard to get ideas for investments. So I think you need to have some knowledge about books. You need to read books, but you also need to read 10Ks or listen to managers and speak to people in the business. And as we say, I mean, do the physical work that Mandelman speaks about. Actually go out and talk to customers, to suppliers, and try to arrange visits to factories and so on. And I think we actually, we sent a question to Buffett about that, I mean, how much to put into each bucket. And unfortunately, we didn't get a response, but I think we have more or less the answer ourselves. I mean, you don't need to say 20% of that and 80% of that. If you don't need so many ideas as an investor in order to do fine. So I think you just need to figure this out on your own, that you read in order to improve your wisdom and so on. You can make better decisions, but of course you need to analyze the world and businesses to actually be able to strike on some of those opportunities that comes up. And then you need to be ready. You need to have the knowledge. It's hard to, when you go into a bear market as this, if you don't have any knowledge about companies, you will start to discount the near future too much. You won't see the opportunities in the long term. And then the risk is that you won't be able to pull the trigger, I think. So you need to have a list of companies that you know, and then you're able to strike quicker, I think.
Yeah, but our guess is that Buffett is not reading that many books these days. He's more focused on his lovely newspapers, and then he's, of course, reading a lot about different companies.
Yeah, exactly.
But do you think investors are reading enough books?
I think most of them are not. As I said before, it's easy if you only read 10Ks, for example. You don't get other perspectives on things that you may need. I mean, you get specific knowledge about companies, and at least for some, maybe for some it comes naturally that you think about all these other ideas. But I think it's like I think you improve your intuition and also your internal checklist to think about. So I think you can process information quicker, and you can understand businesses quicker and better if you read a lot of books. So I don't think necessarily investors maybe appreciate how much you can gain from reading books in your investment process journey, so to speak. So I think many would benefit of at least reading a few books every year. And I think maybe most investors then only read investment books. And I think they could gain a lot from reading other books as well.
Yeah, and also reading more company material and other sources like competitors, reports and so on as well. And not spend time looking at the stock screen.
Excellent. Absolutely. I think probably most people put too much time into checking the stock prices, and that's not, when people say like, okay, how much do investors put into their work? I think many of those hours that they say they put into that is actually managing the portfolio, or actually just staring at stock prices.
And being on Twitter and so on.
Yeah, exactly. And some of that can be good. For Twitter, for example, but
yeah, definitely.
Much of it is noise as well.
But I really liked the concept that Jack Taylor was talking about in our episode with him, the second episode.
You feel like your job as an investor is to sort of stay informed, but if it is so much noise to actually capture the nugget of information, then I think that you may be at odds with success. Now, where I think what can help is Jim Chanos has this analogy that he calls like the information onion. And you look at the very core of the onion where there's the most truth. And that is what I would like the SEC filings themselves. And that's really what the company has to tell you. I would also put then like good books into that, where there's a very high information density to the amount of content that you have to consume. Now, as we move outside of the onion to the next layer, that is more like the company's press releases, the investor relations decks, like the conference calls. And those are all the things that the management wants to tell you. Not necessarily has to, but wants to. Another layer, and that then the equivalent might be for reading a good write-up of an investment idea, perhaps. And then the next layer out would be the like sell side research. And those are like, we want you to take this action. So here we're trying to give you some information to make you do what we want you to do. And that may be more like a blog post or something equivalent. And then finally on the outer layer, you get into like social media and rumors and, just really just like sort of the candy. It feels good. It tastes good. Tweets, things like that. But there's not much caloric density to it. There's no real meat on the bone there. And so where are you spending your time and what's your diet of your information? And so the more that you can spend at that core of the onion, eating the most nutritious bites, I think that helps add to your patience a little bit. And it helps you have a better understanding of the world as well, as opposed to interpreting the very core information through someone else's lens, right? So if you're reading someone else's write-up about it, but you didn't read the source material, you're getting all of their biases baked in on top of it.
So another way to filter information is to use a stock screener. What do you think about that?
And some screening tools are better than others, and I find that in bear markets, screening maybe is more important than otherwise. I think because you have this, we will come in, I think we'll discuss the psychology part of it, but just when you get like this mass psychosis that you can get in really, really bad markets, we're probably not in that one yet currently, but you get a lot of mispricing. And when you get a lot of mispricing, you can find out things with a screener that you can't find in a call market, I think. Because then you need to have a different perspective on things. People don't stay rational all the time, and then you can actually just benefit from looking at financials and logic. So I think it's easier by that time.
Yeah, speaking about psychology, one question that we have asked most of our guests is this: what is your common bias and the mental traps that they fall victim for when they are investing? So what are your takeaways from that?
I mean, Daniel Chang had this wonderful phrasing of that I think was really interesting. That and he writes about this in his book, Investment Thinking Toolbox. And he covered the 11 most important mental models for investors. And what he says is that confirmation bias seems to be the most frequent and most dangerous. And as he describes it, circle of competence is a one-time test, whether you understand it or not. But confirmation bias really keeps haunting you in every decision, in every part of your process. You can get fooled by confirming what you already know, so to speak. So yeah, he has this list of the 7 deadly sins of confirmation bias, which I think was fantastic.
When it comes to investing, it doesn't really help that other people confirm what you think is true. So the framework with the 7 deadly sins is basically the process from start to end, where you start with search, where one actively looks for data and information in order to confirm one's initial view, which obviously can lead to very bad decisions. Secondly, you will have preference. So even if contradicting evidence is found and exists, we tend to prefer the evidence that supports our initial belief, so that you don't have this cognitive dissonance. Thirdly, you have the recollection part, where somehow it's actually easier to remember the information that supports one's initial belief. It's easier to forget arguments and facts that doesn't support it. Fourthly, you would have interpretation. So even if I'm presented with the same set of data as maybe you two, we would interpret it differently. I would probably interpret a little bit closer to what I believe in order to confirm what I believe in. And it's not because I want that, it just happens naturally. And you would interpret in a different way, a little bit at least. Then you have framing. So you could be using mistaken beliefs to misunderstand what's actually happening in a situation, which is a little bit different to interpretation, but still quite similar. Discarding is the 6th sin here, which is about that you explain away or discrediting information that actually does not fit with the belief. So even if you are presented fact, you might think that it's not a fact, it's fake news, as a famous guy likes to say. And the last one is testing. This is something that I struggle with quite often. So it's kind of like the ostrich putting the head into the sand. So when maybe there's a little part of you thinking that maybe I'm actually not right here. Maybe I should look up some more facts. Maybe I should run this analysis again. There's a much more powerful part of the brain saying, no, let's not do that. Because if you do that, there's a risk that you're wrong. So just don't take a look at it again. So when it comes to investing, the important part over time at least is to have a good output and being right in the analysis, which hopefully leads to a good output. So even if one would fall victim for the deadly sins over time, it probably means that one has less cognitive dissonance and maybe feels better about one's decisions on a day-to-day basis by not challenging them. But I am a strong believer in that would result in worse results over time.
When we have asked many of the other guests as well, I feel like we have gotten this answer quite many times. Confirmation and consistency bias is a really tricky one, and you get fooled by it over and over again.
I agree. I mean, if I would answer that question, I think confirmation bias would come quite high up on the list. I think over optimism, maybe that's just because of the situation we are in now, but I just feel that it's huge. Social proof is also huge. There are a few of them that are more important than others, I think.
And if we go into the book section, that's something we also have in every episode. We ask what has inspired them, or if they can recommend something. What have you learned from that section?
Yeah, it's a bit difficult. I mean, some of them have been a bit reluctant to recommend books, but most of them have had a few recommendations, and I just feel that I feel the same about that problem of recommending books. I think that it's so subjective, and I think what I would recommend our listeners to do would be to check out the books and actually maybe try to read the first chapter or so on, that you can often do on Amazon, for example, and read maybe try to understand what the author is trying to do. And if you feel like the book seems to be of the right quality, and you know that, okay, I will probably read this in the future, then I would probably recommend buying it. And what I do is that when I get a new book, I more or less always skim it and try to read the table of contents and the preface and also I go quite quickly to the conclusion. I mean, I try to understand what do the author wants to do. What do the author try to convince me of here? And it's quite easy to see if they use logic and facts when they come up to the conclusion, and then of course how they write the conclusion. What's the conclusion of the book? And then I think about, will this really? I mean, is it necessary for me to take 5 hours out of my life to read this currently? Or do I have another book that is more interesting for me now that talking about passion, it's just, if I'm passionate about a concept currently, I want to understand it, then it's really an easy and light read. It can be a quite complex topic, but I think that helps a lot. I mean, don't just pick up a book and read it from cover to cover, and then in the end you say, this was not so interesting. You have lost quite a lot of time, and I mean, it's good to think about opportunity costs there, I think.
Yeah, definitely. I mean, one book can provide so much value, but it also takes a lot of time to read it, so make sure that it's worth your time. And do you have any other advice or a specific approach when you're reading books?
I mean, I would recommend this book that is called How to Read a Book by Mortimer Adler, a philosopher. I think it's so good. I mean, I think everybody should learn the concepts in that book when they go to school. Because for me, it was like going back to school and really understanding, okay, how should I read a book? It's just, you learn that, okay, you should just read books cover to cover, more or less. And you don't need to do that. I mean, what is it about? I mean, why do you read? Is it for actually gaining wisdom, or is it just to cross somewhere that you have read another book? And I think that's the most important takeaway for me on that.
And how do you read? Do you read physical or digital, or?
It's a mix. Sometimes I read on the Kindle. So if I'm I'm passionate about the subject, I want to learn it now. I've done some work on understanding if a book is good enough or not. Then I buy it on Kindle because I get it, immediately, and I can just start reading it. But I prefer physical books because it's good to write in them and so on. And I really like Eddie. I mean, I think you have some lessons about actually how to write in books in order to gain more knowledge. That's something that's Adler speaks about as well, that you need to write and think about the concepts all the time. But I think you have a process that is quite interesting.
Yeah, it's not something that I have learned. It just came naturally, but I use highlighters to mark what I think is most important, of course. And then I have an ink pen that I just write in the margin when I think something is interesting. It's usually just one word or two words, but that will make it so easy for me to get when I go through the book again, I will see instantly, okay, this is this topic or something like that. And I usually make a star when there is like a big insight for me or something that I'm like, okay, this is a good concept. So it's also easy to find. And then I also have a third pen, which is a red one. And with that one, I make hearts in the margin when I read like a sentence or a quote or something that I really love and I want to keep that one. So, and then of course the book always have blank pages in the end. So sometimes I write my questions or my takeaways or reflections there. So yeah, you can use the book in that way. But I'm sure there are many ways to do that, and it would be interesting to hear if any of you listeners want to like tell how you are using it or can give us some advice. It's always interesting. So we look forward to reading many more books and discussing them with authors and investors. And if you have suggestions of people we should talk to or what to read or want to get in touch with us for any reason, you can do that on Twitter. It's IB_Redeye. And you can also find me and Niklas on LinkedIn, of course, if you want to connect. And we would be super grateful if you would give us a review in your podcast player and help us spread the knowledge with Investing by the Books podcast. Is there something more you want to add?
I just want to re-emphasize what Eddie said. I mean, I think we become better if we get feedback of what we're doing good and what we're doing bad, especially what we're doing bad. So about the Buffett concept, give us the bad news first, or possibly only give us the bad news because we will get the good news anyway.
Yeah, we only did 25 episodes, so I'm hoping we can do many more.
Absolutely. I mean, this is a long-term project and there's so many great books out there that we want to cover. So hopefully we can continue for years.
And next up, episode 26, that will be out in 2 weeks. It comes a conversation with Andrew Wagner from Wagner Road Capital Management. And Andrew is the author of The Economics of Online Gaming. And this will be our first economics book on the podcast. And I think it has many relevant aspects for investors, and it doesn't require any gaming skills. We are not gamers ourselves, so we really enjoyed it anyway. Stay tuned. Thank you for listening to Investing by the Books, a podcast by Redeye. Follow us on Twitter at IB_Redeye and email us at ib.podcast@redeye.se. To improve, we'd love to hear your feedback, so please rate and review us. Notice that the content in this podcast is not and shall not be construed as investment advice. This information is meant to be informative and for general purposes only. For full disclaimer, visit redeye.se. I'm your host, Eddie Palmian, and until next time, I sincerely wish you the best of luck on your journey through life and investing.